All right, I am here with Michael Saylor. He is the CEO of MicroStrategy and really a pioneer, I would say, in the sort of like current wave of Bitcoin, because really the first public company late last year, middle of last year, to make a point about putting some of its treasury cash into Bitcoin. The stock has soared since then. Other companies have since followed suit. Michael, thank you so much for joining us.
Thanks, Joe.
Michael, like I said, you were really a sort of pioneer in this middle of last year. I think it was last summer, saying you're going to invest in Bitcoin, some of your cash. You've done it multiple times since then. You've even gone out and sold convertible debt. How many companies have you talked to? How many public company CEOs have you talked to since then, the last 6 or 9 months or so, who are interested in sort of replicating what you've done?
Well, quite a few. I mean, I can't really share my discussions with public company officers, but it is popping up as a much greater trend in the last 6 months, and I think it's coming to the forefront of the conversation with all companies, private and public.
So you've been pretty clear on this idea that you're not in favor of holding extra cash, especially given your views on monetary policy, the dollar, and so forth. What is it, though, about Bitcoin specifically versus other alternatives, or, say, distributing extra cash back to shareholders? What is it about Bitcoin specifically that, in your view, makes it a logical asset for companies to at least put some of their money in?
Well, I mean, let's look at the big picture. I've been a public company officer for 22 years. When you could generate 5 to 6% short-term interest on treasuries, and you thought that the cost of capital was 7%, then you didn't have to consider anything other than a conventional treasury strategy. You're maybe taking a minus 2% yield per year. I think that when conventional treasury assets started yielding 2% and you had a cost of capital of 7%, which is the expansion of the money supply, it became a minus 5%. People, they grit their teeth and they got through it. That was for the past 4, 5, 6 years. Now in 2020, we've seen the cost of capital explode. It's 25% monetary supply expansion. The treasury strategies are now 0, 1, less than 1%. So you've got a negative real yield, minus 25%. That's the cost of capital. Okay, that's actually turning up the heat that's causing everyone to realize that conventional treasury strategies are broken. Now, what are you going to do? Look at the last 12 months, ROI. Bitcoin is up 461%. S&P is up 25%. If you invested all of your treasury assets in the SPDR, in the S&P index, you kept up with the cost of capital. NASDAQ's up 53%. Big tech, they're monopolies, they're extraordinary, they're staying ahead of the cost of capital. Treasuries, down 7.7%. If you were holding long bonds like TLT, that's a disaster. Gold, up 9%. It's also a disaster. It's not keeping up with the cost of capital. So why Bitcoin? Well, yeah, you can't hold conventional treasuries. You're looking at a negative real yield against the cost of capital of 15 to 25% a year. Right? I mean, I'm not a consumer. I have to control, I have to manage shareholder value. And if you want to maintain or grow shareholder value, you're going to have to grow your assets at a rate faster than the cost of capital. So your hurdle rate is 15%. Now, what are you going to do?
It is.
And I think, yeah, if you look
I mean, it is a different definition of cost of capital that you have than, say, like a traditional accountant would have, right?
I don't think so. I think that a lot of people think about inflation. I think CPI. The cost of capital has always been, in a conventional environment, risk-free, 6, 7, 8%. If you talk to any institutional investor in the past decade and you said, my idea is I'm going to invest your money at 1% or 2% or 3% interest, they would ask for it back. In fact, there's not a single institutional investor that can keep limited partner capital by promising 1 or 2 or 3% returns. So all investors know the cost of capital, it's about 7 or 8. Look, if you look at the compound annual growth rate of the S&P over a decade, it's 11.4% for the past decade. If you look at NASDAQ, it's faster, it's 17%. Big tech is better than the S&P. If you look at the compound annual growth rate of Bitcoin for the decade, it's 198%. Okay, so why Bitcoin? I have to move my money. Look, either got two choices: decapitalize the company or invest the money into something which is going to keep up with the cost of capital or exceed the cost of capital. So let's talk about giving the money back. Well, Joe, the road to serfdom would be for you to surrender all your assets and take a job working exponentially harder for cash, growing exponentially weaker. No family on earth would do that. No investor is going to give all their capital back to the limited partners, right? No endowment's going to work. No university, no company can function by surrendering all their capital and then working harder exponentially for a currency growing weaker. And one more point. The robots are taking over the country. We're automating everything. So for Amazon to succeed, 15,000 retailers are destroyed. For Google to succeed, 15,000 media companies are destroyed. For Apple to succeed, 15,000 device manufacturers are destroyed. So every company is competing against Google, Apple, Amazon, Facebook. These companies are dematerializing their products and they're shipping. Microsoft can bundle a product, ship it to 80 million companies over the weekend. Now, how are you going to make money if you pretty much give up all your capital and you start working to create a new product to compete against Microsoft, Facebook, Amazon, Apple, or Google when robots are taking over the world?
Let's break into a couple of things. So one question, of course, that people have about Bitcoin is, even though it has done very well, the track record speaks for itself. It is also, we know it's extremely volatile. Historically, it's suffered big drawdowns. We don't know when the next one is going to be. In 2017, it peaked around 20,000, got as low as 5,000, I think, March of last year. Is there anything good about holding Bitcoin itself if it's not going up? In other words, during these drawdown cycles, is there anything about the asset that makes it an attractive thing for you to hold?
First of all, it's the hardest money on earth. It's an institutional grade safe haven asset. It's gold without all the imperfections of gold on a digital monetary network that moves at the speed of light that you can program to do 1 million transactions a second. So Bitcoin is digital gold on a big tech monetary network. Why would you want it? You would want it for the same reason that you want to run electric power to your city, or you would want to run running water to your building, because civilization is based on clean energy, clean water, clean communications, clean money, right? It is an extraordinarily important thing. Now, with regard to companies, I think the real issue here is if every currency is correlated to the dollar, right? I mean, they're all trading against the dollar. So if the dollar is weakening, every other currency is weakening, and then every stock and bond and commercial piece of real estate that generates fiat or US dollar cash flows or any cash flows in a fiat currency, they're all correlated assets, and they're all correlated ultimately to the dollar. So if we create 15% more dollars every year for the next 10 years, then you've got to discount the cash flows of every other instrument by 15% a year. And it doesn't take a rocket scientist to figure out that 80 to 90% of the value in those instruments is going to be collapsing if the dollar collapses. So if you want to preserve shareholder value, you have to buy scarce assets. Now, I could look for baseball cards or Picassos or sports teams, but it's hard to buy $1 billion of liquid, scarce trophy assets. So Bitcoin is the most liquid, scarce, uncorrelated asset that you can buy if you're trying to do this in a treasury.
But let me, you keep testing you on that. And we have a question from the audience about your measure of 15% cost of capital and so forth. And others might have it less, as you said in the past, 7 or 8%. But a company that someone typically invests in, a publicly traded company, they don't typically think of them as an investment trust. And they think, the real opportunity is not what they hold, but what they do. And lots of companies are doing well. I mean, you talked about the challenge of competing against Microsoft or Google or Amazon. There's numerous software companies, for example, that are listed that have had phenomenal years. Businesses growing 50% year over year. For most businesses, don't people actually want to invest in the business itself as opposed to, say, some aspect of their capital structure?
I think conventional treasury strategy is now intellectually and morally bankrupt, and it's a road to serfdom, right? And I think that what you're going to find is increasingly there's haves and have-nots, right? There's the elite that have incredible power, like the Googles and the Amazons and the Apples, and they have more money and more power and more distribution than God. And then you've got conventional businesses that have conventional cash flows, and they're being increasingly marginalized. So to ask those businesses to invest all their capital in a currency which is devaluing at 15% or 20% a year is pretty much committing economic suicide.
But the expectation,
again, it's the same thing as, why don't those investors give all their capital back to their limited partners and decapitalize under that strategy, right?
Yeah, but again, the expectation, I think, most investors is not that they're going to hold most of their money in cash per se, but that their fundamental business operations are worth reinvesting. And when I look at the numerous companies that are surging, hitting all-time highs, a proliferation of software companies and banks and industrials, they're companies that are not holding a lot of extra cash in any asset, in any treasury asset. And so the question is, why should we evaluate companies based on what they have in their treasury assets versus what they can fundamentally invest in with their operations and the things that they actually sell?
I think it's pretty clear that we have a Main Street versus Wall Street dichotomy here. And if you have a company that is asset rich, then you've got a 25% boost due to money printing of the Fed over the past 12 months. That's the M2 money supply expansion, roughly. And if you have a company which is cash rich and asset poor, your business is just getting exponentially harder, and any cash that you have is being degraded at the same 25%. The S&P is up 24.61%. Which means that if you want a proxy for cost of capital, if you invested in any kind of company that was up 5% over the past 12 months, you're not keeping up with even the index. Right? So if you're an active investor, you're going to have to find a way to get above 24%.
Let me switch gears for a second, and this is, I think, an important different dimension. It's different from sort of macro, which is that, and the whole reason we're having this conversation.
Can I make a point? I don't think a company can be successful if it doesn't have a large asset portfolio and an environment where you've got such aggressive monetary expansion. If you had an environment where money was expanding at 0% a year, then you could focus upon the manufacturing of things. But in an environment where the money is expanding at 20% a year, everything you're doing in the future is being discounted by 20%. So in essence, as the money supply expands, all the future activity of every business is being discounted until it exponentially goes to zero, which means that the only path you have in order to create or preserve shareholder value is to forward finance your cash flows. Like, you have to look out 20 years, borrow against 20 years of cash flows, and convert it into an uncorrelated asset, which is going to appreciate faster than the rate of money expansion. Otherwise, and you can see this in Venezuela or Argentina, the business as an enterprise, or the enterprise value of the business, goes to zero as the money supply expands. You don't have a choice.
I want to switch gears for a second to another important dimension of Bitcoin. And part of the, we're talking here because there's obviously a lot of institutional interest in the asset class, or crypto, however you want to call it. But one of the important things about Bitcoin is that I can send you a payment, or you can send me a payment without the permission of any sort of third-party regulator or bank or entity that could say no. This sort of pure peer-to-peer cash online. From a regulatory or institutional perspective, is there any anxiety about holding an asset which has so much ability to essentially evade censors, evade capital controls, evade taxpayers. And are you worried about that tension at some point down the road, the intersection of institutional holdings and the sort of like original cypherpunk roots of the currency?
I think the underlying integrity of the network, which allows you to take personal custody of your assets, it creates the foundation upon which to create an institutional grade store of value. And without that integrity, you couldn't be sure that your custodians would treat you fairly. But having said all that, I think every institution is purchasing Bitcoin through regulated custodians, and so you're buying it in lieu of gold. Or our choices, if we wish to avoid insolvency, are you buy gold, you buy a portfolio of stocks. Perhaps you go and you buy a bunch of timberland or oil contracts or some kind of commodities. Companies have to become asset rich if they're going to prosper and maintain shareholder value. So Bitcoin is the highest quality property that they can buy. As the regulatory environment is already pretty clear on this. I mean, AML, KYC regulations have been applied across all of these exchanges. I think that there's a little bit more parity and precision that will be delivered in the coming 1 to 2 years. I think that's going to be the green light for institutions to invest 10x to 100x more into Bitcoin. So I think it'll be good for the industry in general.
Let me ask you, you know, if a CEO came to you and maybe they weren't that tech savvy or whatever, they said, how should I want to buy some Bitcoin. I don't know how to hold it. How do you hold your coins as a company? Do you have access to the private keys, or does it make sense for companies to just hold their Bitcoin with a third-party custodian?
No, I think for any kind of, for a private or a public corporation, if it's really a corporate entity, it makes sense to use an institutional grade custodian, and there's a good dozen of them that you can choose from. If you go to our website or go to hope.com, we've got interviews with 10 of the more notable ones in the marketplace. I think that the use of Bitcoin for institutions is they're going to access it through derivatives. They're either going to buy funds that are backed with Bitcoin, like Grayscale or other kinds of funds. They may buy the underlying asset through an institutional grade custodian, but they'll fundamentally work at those three levels. I think that there are individuals will want to take personal custody of their Bitcoin, and there'll be other entities that do that, and they're the minority, but they provide the integrity to the system that keeps everybody else honest, and I think that's the important role they play.
We just have a couple more minutes. I want to ask you, you've done a few convertible debt offerings, and the pitch is someone buys convertible debt from you, you buy Bitcoin. If that sends your stock price surging and your stock has kind of become a Bitcoin proxy, then the debt converts, and that's a great trade. If Bitcoin falls, then there's safety because you also have your business intelligence business undergirding the value of those cash flows. Is there a limit to how many more of those offerings you can do, or do you see yourself continuing to sell more convertible debt to buy more Bitcoin, and how much could you see yourself doing?
Our company has two strategies. One is to grow the enterprise software business intelligence business, and the second is to acquire more Bitcoin. And we've been pretty clear that we'll consider equity and debt financings or sweep cash flows we have into buying more Bitcoin. My view is Bitcoin is the underlying base layer of an emerging digital monetary network. If I told you that one day there'd be $100 trillion market for timberland, you might want to buy timber. And if you knew there's $100 trillion market for any other asset, oil or diamonds or name it, you'd want to buy a bunch of it. So we believe there's a $100 trillion total addressable market for a digital monetary network. It makes sense to buy as much of that asset class as we can. We think it's
so should we expect should we expect more convert offerings in the future?
I think we just evaluate the market, you know, and our view is look for anything we can do that's accretive to our shareholders. And there are circumstances under which there are things that are accretive, and there are circumstances under which I wouldn't think so. And so you just have to stay tuned on that.